So what is supply and demand? Supply and demand is the interaction between buyers and sellers in the market. So when there's more demand for an asset, price goes up, and when there's more supply, price goes down. And we use these supply and demand levels as areas of interest to trade from. So we'll pick a level, and then as soon as price gets back to there, we'll look for an entry. So we'll mark that level up, and if it ticks these boxes, then that's what makes it a good level to trade from. The whole market's made up of supply and demand levels, so we have to be specific of which ones we want to trade from. So here you can see 4 examples of supply levels to trade from, and the first one sweeps liquidity. So as you can see, price comes up, taps into demand here, sweeps this high that's created by tapping into demand. So the demand will be somewhere from the left. Price comes down, up, creates this high, sweeps it, leaving behind the supply level, and then breaks the demand. Therefore, we look to enter from this supply here. The next one is where it breaks structure. So as you can see, it breaks structure here and leaves behind the supply level, which broke the structure. It doesn't need to be a swing break of structure. It can be an internal break. So that's something to bear in mind. Next one, it flips demand. So as you can see, this demand is created by this break of structure. Price comes down, taps into demand, pulls back, and then flips the demand, leaving behind the supply level here. So we look to enter on this. And the final one here has inducement. So this supply level is created from something above, comes down, creates this inducement below it. So inducement is always a good sign, because what it means is there's stop losses above these levels. So it doesn't have to be equal highs, it can be just a single high like this below the demand level. And this means that there's early sellers being induced here. So as soon as retail traders see that price is coming down, what they'll do is they'll look to sell, and they'll place their stop losses above the high. Price then comes down and runs back, taking out all of these stop losses, tapping into our supply, and then running down. So we look to enter off of the tap into supply. And here's the examples, but in demand format. So these are good demand levels to trade from. The first one, it taps into a supply here, pulls back, and then creates this low before sweeping it, leaving behind the demand level when supply fails, which we look to trade from. Break structure here, you can see this demand broke this internal structure or external, leaving behind this. Flip supply is where tap into supply, pull back, supply fails, demand, we enter off of this. Has inducement, again, comes up, creates this inducement above the level, and then we enter on the demand. In the next video, we're going to be applying this to the market with some examples, and you can see that we'll use more than one example per supply demand level, because the more you have, the better of a level it is. So some supply and demand levels have one of these, and some have all 4. So if you can get all 4, that's obviously a better confluence there. But to be an actual supply demand level, it has to have at least one of these. So yeah, I'll see you in the next video.